Hey everyone, I'm Prithvi Ramdanath and welcome to this week's edition of Wealth Whisper Weekly, where we unpack economic headlines in a simple, honest way and tell you what they mean to your money, your SIPs, your loans, and your future. So this week, there are 10 major developments that were the movers and shakers of the Indian economy. Some were positive, some were negative, some were warning bells as well. By the end of this video, you will know exactly how they will affect and what are some smart moves you could consider. All right. So the 10 key developments and their impacts are here. So number one, Reserve Bank of India, that is RBI, cuts repo rate to 5.25% from 5.5%. So on December 5th, RBI's Monetary Policy Committee, that is MPC, unanimously cut the repo rate by 25 basis points. Earlier it was around 5.5%, now it is around 5.25%. This means borrowing gets cheaper now. Your home loans, auto loans, personal loans, many EMIs could come down. That's a good news for all the borrowers. For new borrowers or people with floating rate loans, this is an immediate relief. But to reflect in your loans, it will take at least 3 to 4 months time. So don't just go rush to your bank just now and ask for a reduce in interest rates. They might not do it. It will take around 2 to 3 months or 4 months to make sure that this repo rate cut will impact your loans. All right. And the lower interest rates make economic activity and corporate growth easier. That often boosts stock markets, and that is what we witnessed on 5th of December. The market rallied a little bit on 5th of December because of this good news of repo rate cut. The second big news is big liquidity boost. Some liquidity measures and bond purchases were done by RBI. Alongside the rate cut, RBI announced it will pump liquidity into the system. How? Through OMO. What is OMO? OMO means open market operations. RBI bought back almost 1 lakh crore worth of existing government securities and bonds in which banks had invested. So this buying back of 1 lakh crore of government securities gives the bank 1 lakh crore of liquidity. And this liquidity, using this liquidity, banks can give more loans to retail people or more loans to companies and retail people. Along with that, RBI also executed 3-year USD INR swap of 5 billion. So what does USD INR swap of 5 billion do? In this, RBI will buy 5 billion of US dollars from bank and give the bank equivalent rupees, which is around 45,000 crores, with a promise that after 3 years they will reverse it back. So RBI will give dollars and take rupees from bank. That is what will happen after 3 years. Now this also increases liquidity in the bank, because earlier RBI's intervention to defend the rupee had drained liquidity from banks, pushing up borrowing cost. With this infusion, banks will have more money to lend, hopefully passing on the benefit to borrowers. For investors, more liquidity tends to ease bond yields and support both debt funds and equity, as companies find it easier to borrow and expand. And financial conditions will start improving. So that is what we are foreseeing by this big liquidity boost. The third news is RBI raises FY26 growth forecast to 7.3%. In the same meeting, in the MPC meeting, what we had, RBI upgraded its growth projection from for FY26 to 7.3%, up from around 6.8%. So earlier it was 6.8%, now it is around 7.3%, the expected projection. That implies the economy, despite whatever the global headwinds, rupee pressure, the trade worries, it is still expected to grow at the healthy clip. Analysts are calling this a sign that that domestic demand, consumption, and credit growth remains resilient, a positive for companies dependent on Indian growth. So, for you as an investor, what does this news mean? Stable or rising growth tends to support corporate profits, which may translate to better returns in your equity funds, especially those tilted towards domestic demand sectors. So, this is a good news for you as well. Now, markets also surged, then some stabilization with twin boost of rate cut and growth optimism and liquidity injection. So, stock markets, that is Sensex and Nifty, shot up initially at the start of the week. Actually, it dropped a little, and but the end of the week again it rallied up because of that repo rate cut. So banks, financials, consumer oriented businesses, and credit sensitive names saw early gains. So this is also, there was good news in the market as well, but as always markets remain cautious. All right, market remains cautious. So decline in global confidence, currency volatility, and external headwinds, that is the global headwinds, kept the rise checked. That means underlying opportunity is there, but there is also risk. The fifth news is rupee is under pressure. USD INR around 90 dollars despite 90 rupees despite liquidity support. The rupee remains fragile. Forecasts from some banks indicate that USD INR may go beyond modestly above 90. So RBI is not too much concerned about how rupee will move, but they're too much concerned on bringing up the inflation number up and also infuse liquidity in the market. They're not much concerned in current situation about how the rupee will behave against the dollar. A weak rupee actually pushes up the import cost, like oil, raw materials, industrial imports, etc. This which can fuel inflation or squeeze margins. For investors in sectors dependent on imports like oil, certain manufacturing, electronics, that's a risk. On the flip side, exporters may benefit, but if rupee volatility continues, that adds uncertainty. Yep. Now the sixth news, mixed FII and DII flows. So domestic investors holding ground and foreign institutional investors have shown some outflow pressure. But those losses are being somewhat offset by continued buying from domestic institutional investors, and also retail investors also contributing in investments in Indian markets. As it is the start of the month, many people would have set up their SIPs 5th of month or third of every month. So many have SIP deductions happening, which has boosted the domestic investments in this week. So the shift in ownership indicates that long-term domestic investors are stepping in when foreign money flees away. For you, this could mean lower volatility than a full FII driven market and potentially better medium term opportunities if domestic demand and consumption picks up. So this is again, we are in a very neutral stage, markets in a very neutral stage. Domestic players are injecting a lot of money, investing a lot of money, but FIs are removing it. So there is kind of inflow outflow kind of a balance, and this is what holding the market at the same stage. But if domestic demand and consumption picks up, I think there are better opportunities, better market opportunities in near future. The seven news, inflation outlook remains benign, more room to cut rates or keep them low. The headline inflation has cooled significantly. Okay, the CPI has reported at record low levels of 0.25% recently, and that gave RBI the breathing room to cut rates while still protecting price stability. This lowers cost of borrowing and encourage consumption and trade growth, and good for real estate, auto consumers, durable sectors, and sectors which are linked directly to everyday demand. See, we need to understand this. Whenever there is a rate cut, the loans becomes cheaper, the consumptions, the because the loans become cheaper, people consume more, and when people consume more, the inflation number increases, and when inflation number increases, it is considered as the growth in the market as well. So, if inflation remains subdued, there's a talk among a lot of economists that more rate cuts or at least stable rates might follow. That's a supportive backdrop for equities, especially domestic market oriented ones. Now, the eighth news, important news, is industrial activity and capex. The mixed signals. Despite supportive monetary policy, some industrial indicators remain soft. Production growth and core sector output have shown signs of cooling. That suggests corporate capex and manufacturing output aren't yet firing on all cylinders. This divergence, this supportive policy but weak industrial activity signals caution. Yep, this is a warning bell. So companies reliant on manufacturing, exports, or heavy industry may struggle in near term. This means that while the rate and liquidity support helps, sectors sensitive to global demand or raw material costs might remain volatile. Now, the ninth news, sectoral winners and losers rotation underway. Given the above mix, that is the rate cut, liquidity boost, rupee pressure, global headwinds, we are seeing there's a lot of sector rotation happening. Financial sector, bank sector, credit sector, credit driven sectors, domestic demand names like consumer, real estate, infra appear to get favored, but export heavy, rupee sensitive, and raw material intensive sectors face these headwinds now. For investors, this underlines the value of well diversified portfolio, the importance of well diversified portfolio. The large cap funds may weather volatility, mid cap, small cap funds with domestic demand tilt might see growth, while blindly holding export linked sectors could be very risky. And last but not the least, the big picture, India's Goldilocks movement, growth plus low inflation plus liquidity put together, a rate cut, upgraded growth forecast, benign inflation, large liquidity injection. The RBI calls this a rare Goldilocks period. For long term investors and salaried professionals, this could be one of the best windows to deploy capital. Home loans are getting cheaper, EMIs are getting lighter, companies may invest more, consumer demand may rise, creating a virtuous cycle for economy and markets. But, and this is a big but, only if you stay calm, stay diversified, and avoid getting carried away by short term noise. All right, so that is why don't worry about the short term noise. This considered as an information and not as a noise, whatever I'm sharing now. And this will make sure that you have clarity on what things are happening, and it will help you to stay put in the investment for a long term. With that intent, this video is getting created, this weekly series is getting created. All right, so saying that, what are my final thoughts for the week? We often treat macroeconomic announcements as background noise, meant only for economists or banks or financiers. But this week proves something different. These decisions, all right, these decisions shape our lives. How much we pay for loans, how much our savings grow, how secure our jobs are, how much we spend. So these are all very important things which the macroeconomics impact. All right. So this information will come handy if you keep yourself educated about what is happening in the economy. So if you understand what just happened and act with discipline, you could turn these headwinds into a meaningful advantage. If not, you will have clarity about your investments and what is happening in your financial life. Lower EMIs, better returns, smart investments, peace of mind at the end of the day. That is more important. After saying this, if this video helped you see clarity, like, hit subscribe to Wealth Whisper Weekly and share with one friend or colleague who's confused about these economic headlines but making decisions in a very chaotic manner. Yep. Let's stay informed, calm, and build wealth wisely together. So I'll see you next week.